Dennis, I'm not sure at this point whether, pause or hike matters so much as whether investors should think, based on how things are going, that the Fed has this inflation situation under control. Do they?
I don't think they do yet. I think we're living in a 4.5% world of inflation. There are some signs that can be grasped of declining inflation, but it's very gradual. And I think the committee still has a big challenge, particularly with a 2% target.
So why signal the possibility of a pause? Is it this thought that the credit markets were going to seize up after March, which at least anecdotally doesn't seem to have happened? And then how much pressure does that put on the CPI and PPI reports?
Well, I think the question of credit tightening is something that's on the mind of members of the committee, and they would like to see more evidence that it's happening, particularly if they're going to treat credit tightening as some kind of a trade-off with with further hikes. But overall, I think they can support a skip based on the cumulative tightening that's occurred to date, the factor of credit tightening, and the argument that there are lags that haven't kicked in yet. So those are the arguments I think that would support a skip. And it's my view that probably they will skip next week.
Well, looking at a micro level at some qualitative information, we're just talking to Max Levchin from a firm. It doesn't seem like he's doing any, wholesale pulling back in credit availability. His sources of credit are still eager to deploy it, relatively speaking, but he is watching the impact later this year of student loan repayment coming back. How much are you thinking about that and how it influences the back half of the year, and particularly Q4?
Well, I heard that comment in the run-up to this interview. I find that interesting. I haven't given it a great deal of thought. I would think that the student loan repayment resumption would be a factor in consumer demand, and how the pretty large population that has educational loans is actually going to treat its monthly spending. And that could be part of a slowdown. There's no question about it. Beyond that, I really don't have a comment. I haven't given a lot of thought to that as a factor.
Right, but just conceptually, it could be sort of like inflation, right? If there's less money that consumers have available to spend on other things because there's this other cost that they now have to factor in monthly?
It could contribute to disinflation, which is exactly what the Fed wants, actually. So in some respects, a little bit of slowing down of consumption would be very welcome from the Fed's point of view. And yes, the student loan question could be a contributor to that.
I just meant it could feel like it in terms of the consumer doesn't have as much money to spend on other things because of costs that have appeared. And, based on that, then what's the investor position usually during times like this? I mean, I know that the markets were exuberant when money was easy. That's happening less. Traditionally, how much do market gyrations influence what happens here?
Well, on the question of market gyrations and how they influence what happens, clearly it's part of the calculation among consumers of how wealthy they are and how comfortable they are with major outlays and spending. So it's a factor, particularly IRAs factor into the thinking of, let's say, a broad swath of the population. In other respects, from an investor's point of view, you're always dealing with uncertainty and always dealing with risks that could develop. And at this time, I think the question for many investors is going to be how much further does the Fed have to go to actually get a decided disinflationary trend moving toward target.
Right.
And I think that's sort of that's the question of the moment.